This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Tim is a partner and director of investment at PFP Wealth Management in the UK. I first got turned on to Tim's work through Charlie Newsom, who had been forwarding me Tim's newsletters. Tim makes no bones about it. He comes more from a fundamental value-based perspective. However, what I really liked about his newsletters was just the pragmatic, almost investigative look into what's going on within government and central banks in the last 5 years. And it just intrigued me at how blunt and how direct and how right Tim is. Now, some of the audience is surely saying, "Oh, Covel, who cares about being right? You're a trend following guy and all this other stuff doesn't make a hill of beans difference." Look, there's a reason why traders Bill Dunn and Rich Dennis have been on the board of the Reason Foundation. Yes, they might see trading and trend trading and technical trend trading as a means to profit. But that doesn't mean they don't have a view on a properly functioning society. And so, Tim, like Bill Dunn, like Rich Dennis, like many other people I know, comes from a liberty perspective, which is, look, let's try and be fair about things. Don't let the government and the central banks not only pick the players, pick the winners. Heck, they want to pick the scores of the games. The whole idea of price discovery has just been thrown into a tsunami of nonsense in the last 5 years. Now, once again, that perspective has nothing to do with making money. But I think Tim raises some great points in the podcast, in our interview, that make you think about society. It makes you think about how we have allowed the central banks and the government to exert the power that they do exert on society. It's not pretty. It's not rational. It doesn't make any sense. Oh, actually, it does make sense if you're a beneficiary, if you're a friend of the government, a friend of the central bank. But that's not what we want. We all deep down do want free markets. We all deep down want to have the belief that the harder we work, the greater our reward can be. I think you'll enjoy this conversation with Tim. On the backside of the conversation, I'm adding an excerpt from a TED clip, a TED video clip that I saw, and it was forwarded to me by Clint Stevens talking about Bitcoin. My podcast the other day with Brad Rotter drew a tremendous interest. I don't know if Bitcoin's going to be a digital currency winner or not, but boy, it's starting to have that feel and that smell just like Netscape did back in the day, just like Google did, like Facebook, like Twitter. It's starting to have that feel. There's something there. This TED clip that Clint forwarded me is nice. It gives a nice explanation. And I think it also works well on the backside of my recent Brad Rotter interview. And by the way, Brad did alert me, because I was asked this question because Brad brought it up in his podcast, about the idea of the Bitcoin wallet. And Brad wrote me back and told me that Coinbase is okay. However, first, let me jump into my conversation with Tim Price.
Tim Price, good morning.
Hey, Tim, this is Mike Coveil. How are you?
Hi, Mike. How you doing?
Not too bad. Not too bad. So you've got me all fired up. I shouldn't be that fired up, but every time I read your newsletters, you get me all fired up.
Oh, that's very kind. Thank you.
Well, you sound much more calm than you're writing, actually. very, very level-headed. So here's where I want to jump in. So quite a few people that follow my world are probably like, hey, Mike, you've got this technical trend following view. Why are you so interested in Tim? And I think, it's not that you've come at it more from a fundamental perspective, more of a value perspective. It's not that I think your newsletters are attempting to say, hey, here's my quote, secret trading sauce. But I think what you're doing is you're just challenging people to think and saying, what in blazes is going on?
I mean, from my perspective, the last 6 years has been fascinating. I've been working for over 20 years, but I've learned more in the last 5 or 6 than I've learned in the previous 15. And my background's not economics, so I read English at university. But I kind of ended up in the city by accident. And then one of the reasons I ended up in the city by accident was by dint of having an older brother that did go the traditional route. He wanted to work in the city. He wanted to be a trader. He read economics at Cambridge. But to his great credit, he confessed about 6 months in that as far as his degree course had any practical application to life in a dealing room, he'd spent 3 years, 3 years of his life had just been completely and utterly wasted. It was utterly irrelevant. And I found that an intriguing perspective. And, like a lot of city folk, probably didn't think too much about, quote, the fundamentals, unquote, for the rest of the time. So I started out as a bond salesman, then moved into private client portfolio management. But it took the events around 2006, 2007, when it became quite clear that something had gone badly wrong with the capital markets. And I think a lot of us then started to do a bit of detective work. And as a colleague of mine, Killian Connolly, puts it, if you fall down the kind of Austrian school rabbit hole and you sort of breathe freely in the air down there, it changes your perspective on everything. There's no going back up after that.
What are you doing breathing freely? What's that all about? There's no more liberty. Stop that. Come on. So here's one that I'll let you run with. This was, and I implore everybody, I'll make sure I give the link and everything, but I implore everybody to read your newsletters. But you quote Jim Grant in one of yours, and you have a very simple statement that you quote from him, and I'll let you expand. But Grant says, at the heart of the Fed's regime is a subordination of freely discovered prices to policy goals. And I think that is a loaded statement, and it is, in my humble opinion, 100% true.
But it's a deceptively calm statement. You have to kind of think it through. It doesn't come out with all guns blazing, like you say. You have to kind of give it a bit of thought. This is certainly something that I think. Again, the whole world has gone down the rabbit hole now. Pretty much everybody now seems to believe that the people at the Fed, the people at the Bank of England, the people at the ECB, let alone the people at the Bank of Japan, are sort of, tinkering with a machine to try and optimize its performance. And I think that the harsh reality is, and Keynes himself said it quite well. He said in the middle of the Depression, something along the lines of, I fear we have sort of gravely erred in playing with this machine, and the outcome could be, very difficult times for a very long time. And I think this gets to the heart of perceptions of what the economy is or isn't, and what if you like, a managed economy is or isn't, and the extent to which you can even manage an economy. So the way that I think a lot of the sort of the neo-Keynesians approach this is, it's an engine, it's a tool, it's a mechanism, and if you put in the right inputs, you get the right outputs. But I mentioned sort of, there's this detective study, this detective, course that, effectively I've been on and my colleagues have been on. I think probably everybody's been on, trying to fathom what on earth is going on, in the financial markets, the financial world since everything blew up five years ago. And the reality is, I think the so-called Austrian school are on the right track. It is not, the economy, the markets, they're not an engine, they're not a tool. I think that ultimately, what I understand of people like Ludwig von Mises is, the economy is not an engine, the economy is us. The economy consists of the interactions between literally millions of people, and there's no model for that. And if you think you can model it, and if you think you can tweak inputs and get certain outputs, then you are dangerously off track. And I think that's sort of what Jim Grant was getting at in relation to the Fed. The Fed thinks, I mean, I have sympathy for central bankers I mean, I don't believe that they should exist. I don't believe that central banks should exist. I think we should have a free market in money. Now, I appreciate that's not easy to come by, but nevertheless, it doesn't, just because something's difficult doesn't mean you shouldn't try it. And, these guys, I think, have painted themselves into an appalling corner now. So, as Jim Grant will say, if you hear any of the recent statements he's made, the Fed's all over the shop. It's printing $85 billion a month and buying T-bonds and MBS with that. It's impacting the stock market. It's for sure impacting the price of just about every financial asset, including gold, which is something that some of us hold quite dear because it's honest money. And, where does this end? And the Fed had an opportunity to, quote, taper, unquote, a month or so ago. And for reasons best known to themselves, they chose not to. So it is quite plausible to fear that, QE will never end, or it'll never end until it ends in a very disorderly manner. But the role of a central bank, for some of us, assuming it has a role at all, is effectively to act as a lender of last resort to the banking system in extremis, and just to oversee, if you like, but not necessarily interfere with, the monetary mechanism. But the reality is we live in a world now where central banks are basically trying to keep inflated financial assets on this highly dubious premise that you get some kind of trickle-down wealth effect if you keep the stock market up. But all that seems to be happening is you're taking money away from poor people and giving it to rich people. It's a travesty.
Yeah, it's a wealth transference for sure. I've seen that in your writings, you've actually referred to what's going on. It's a black comedy. And I thought that was a great, very concise descriptor of, and I think the hard part for people is that the average layperson, they could be a college student, it could be an attorney, a doctor, anybody. These conversations, they don't appear to be out in the open. Like what's going on doesn't appear to be out in the open. The only thing the average person can see really is, well, okay, I don't get interest anymore on my savings, but look at that stock market. Look at that stock market go up.
Yeah, look at that rocket go.
Right. So, there was another comment that you put in one of your newsletters from Paul Singer, and I'll just read this briefly. He said, the recent trading environment has felt something like walking into a place and having a sense that something is wrong and dangerous, but not knowing exactly what will happen or when. And I obviously can see why you wanted to cite that, but I'm sure you could like to expand on that some.
Again, I think, to his great credit, Singer was being very outspoken. He didn't need to have said those things. And this is one of the problems about economic agents, and particularly about asset managers, that, the financial services industry and the fund management industry is kind of dependent on bulls. It's kind of dependent on a bullish argument. It's kind of dependent for marketing purposes on people saying, nothing to see here, move along, everything's fine. And so for anyone to simply challenge whether the emperor is wearing any new clothes or not is problematic. And that touches on the nature of the organization that one works for. There is no doubt in my mind that if I was working for a large banking type organization, I would not be able to write what I write. So I feel extraordinarily liberated to be able to work effectively as more or less someone who's self-employed, who works in a small private partnership, who can speak freely about markets. Now, having said that, I'm under no illusion that in some instances we probably drive people away from becoming potential clients because I'm stating things that I think are quite gloomy about our financial situation, our financial predicament, if you like.
But I'm guessing, even though we've not yet met, I'm guessing you're probably not like a doom and gloom guy hiding in a backyard cave, waiting for the end times. You're probably saying to yourself, let's be practical here. What is going on? And as you said, as a detective type thinking.
Yeah, I mean, that I think it's very fair. So, what my role, the role of my colleagues, my team is, for better or for worse, we've ended up with this specific mandate. We are managing people's life savings. We are managing some might say, sacred assets. I think it's fair to say in pretty much every instance we're managing irreplaceable capital for people. They might be pensioners, they might be business people who sold a business, but these are, they're not wholly exceptional people. They're ordinary people, and they've saved a bit of money throughout their lives, and they're looking to us to try and protect and grow that capital in real terms. And having been working now for nearly a quarter of a century in the capital markets, that sort of modest-sounding objective, that modest-sounding mandate, it feels it seems very, very difficult. So when I write, and my colleagues write, when we write about markets and we write about our process, we're effectively, we're not trying to hit the drum for drum up business. We're simply expressing our view about how we're trying to navigate very treacherous waters and effectively trying to reinforce, a philosophy that we happen to be following. So we're not Armageddonists. We're not wearing, tinfoil helmets. We do see value in hard real assets. So that forms a component part of our client portfolios, but not to the exclusion of all else. So we allocate to, we're capital allocators essentially at the end of the day, and we allocate to a variety of different types of assets. So we allocate to objectively high quality credit, objectively high quality bonds as far as we can find any. We certainly prefer to allocate to defensive equities, listed stocks, common stocks, again, where we can find them. And the one good thing, the one positive thing you can say about the world financial environment, precarious though in our view it is that there is almost infinite choice. So it's not as if we deliberately don't have any constraints at the portfolio level. So we're not constrained by indices, we're not constrained by benchmarks. The only benchmark we effectively have an interest in is an absolute return one. So we're ideally trying to pursue, again, capital preservation in real terms, but also a degree of, a sort of prudent capital growth. So our benchmark effectively is, you can either call it cash or you can call it inflation. And obviously inflation itself is being, we'd argue fairly heavily manipulated by the authorities. But we allocate to bonds, we allocate to stocks. And then the third and the fourth allocations, where life gets a bit more interesting, we allocate to what we'd call uncorrelated funds. And what we mean by uncorrelated funds, or what we use for uncorrelated funds, is very specifically systematic trend following funds. So the one area of our sort of asset pie that we're very happy to outsource to third-party practitioners is, let's call it the CTA world, if you like. It's trend followers, because we don't have that skill set. We're not traders. We consider ourselves to be long-term value investors, but we see a role within our little sort of asset allocation pie chart for genuinely uncorrelated assets. And the best quality, or the finest form of uncorrelated assets we've found to date, are trend following funds, not least because their historic correlation to the stock market is literally zero. So whatever the return stream is likely to be, and of course we don't know what that return stream will be, but whatever that return stream is, we can state with a degree of conviction and confidence that it's going to be completely unlinked to the performance of stocks, and probably to bonds as well.
Let me go into one that I think is really, I'm sure it troubles you on a daily basis. And I mean, look, to some degree, I want to see everybody be successful. But when you see so many people running their lives attached to benchmarks and trusting the Fed and all this other kind of stuff, that clearly then if that's their plan, then the results they'll get are the results they get. But when you think about the idea in this current climate, after watching the S&P crater over 50% twice in the last 13 years. We're at all-time highs right now. We have no interest rates. And it's almost like the conversation of the idea of another surprise event, another black swan. How people are not imagining that just from a buy and hold perspective, the S&P could do another 50% dip. It's almost mind-boggling, the propaganda that's out there that keeps that quiet. Yes, you're beating the drum in your newsletter, and there's other people on various web channels beating the drum, and I try to do some too. But it's such a minority where it's such a big issue. It's just amazing.
I completely agree. I mean, but this comes back to what I say about sort of economic agents and the nature of the financial services and asset management profession. There is frankly not much money in being realistic, given that people love to form crowds. So, I'm thinking, I think it's Animal House, National Lampoon's Animal House, where you've got a guy in the middle of the road and saying, all is calm, all is well. And then this mob just sort of steamrolls over him, and he ends up being a sort of flattened out piece of cardboard. All is well! The reality is it's quite lonely and quite dispiriting to be the naysayer at the party. And of course, everything is now a gigantic party. So I forget the name of which Fed governor it was who said that the role of the Federal Reserve is to sort of, to take the punch away just when the party gets going. Things have now become 180 degrees reversed. The role of the Fed is now to keep spiking the punch until everyone's comatose, until everyone's fallen over. And I agree, it's extraordinary. Like you say, we've had 13 years and the stock market's crashed twice. And the chart I've got in front of me is a chart that I'm sure a lot of your readers and listeners will be familiar with. It's Robert Shiller's CAPE P ratio for the S&P 500, which you can get from his own website. So he publishes it daily, and it's a chart of the cyclically adjusted PE for the US stock market, basically on a 10-year smooth basis. So it kind of it takes out some of the noise, and you can see quite clearly the historical trend. Now, the historical, as things stand today, the S&P 500 is trading on a CAPE, a cyclically adjusted PE of over 24 times. Now, without wishing to scare the horses, every single time in history in the last 150 years that the US market has traded at that multiple, it has been followed by roughly a two-decade bear market. These facts are incontrovertible. The two outliers to that trend were actually worse than that. So when the market was trading significantly higher than that on a CAPE basis, those times were 1929 and 2000, and those periods probably speak for themselves. But the reality is, I think Shiller's CAPE measure is perfectly fair, perfectly rational, perfectly sensible, and it is flashing a very pronounced red warning signal to anyone that thinks that the stock market is a natural place to be right now. We're not saying that stocks don't make any sense. We're not saying that there's no point in buying stocks. But what we're saying is, we have a very selective view of financial markets and financial assets. We prefer to play a game by our rules rather than by everybody else's. So if we don't happen to like a market because we think it's expensive, it's quite straightforward. You just want to buy that market or buy something else. So the markets that we think, for example, undoubtedly are, quote, cheap, unquote, right now, they're not traditional Western markets. We like Russia because Russia's dirt cheap, albeit there are issues over corporate governance. We accept that. And the other market, which we think is just a fantastic secular growth opportunity, is Asia, and more specifically Asian domestic consumer stocks. Because, our thesis would be right now that the West, under a crippling debt load, has gone pretty conclusively ex-growth. That anyone looking at, say, economic data from the last 10, 13 years is looking at the wrong data, because that was a false market. That was a bubble market. Valuations there and economic trends were triggered largely by credit. In other words, it wasn't real wealth being created. It was simply, future money borrowed from the future, which has to be paid back. But the huge advantage of, say, this Asian domestic story, which we think is utterly compelling, and we're not unique in this. There's plenty of people who are also sort of following this trade. OECD figures, OECD forecasts suggest that the Asian emerging middle class is currently, say, around maybe 300 million people today, but it'll grow to something like 2 billion plus people over the next 20 years. Now, if that forecast is remotely correct, that is a fantastic, compelling, investable opportunity. Can I
add a fundamental there? And I'm not a fundamental guy. Because I'm in Asia right now. I'm calling you from Vietnam. Asian ladies like to shop.
I think you've said it all. We rest our case.
And I'm not saying that in a negative way. I'm just saying, let's be real. Asian ladies love to shop. All ladies love to shop.
But if they get wealthier, I mean, that's a fantastic opportunity, surely.
Yeah. I find what's interesting, too, when you describe the Fed situation, we describe some of these potentially negative outlooks, not necessarily because we're negative guys, but just being realistic about the numbers. the pushback is usually pretty immense. And I've seen some of your peers that have similar views, and the pushback becomes, oh, look at his performance. His performance is terrible, this or that. And I think what people need to realize that if a guy like Tim, like you, if you come out and you kind of put some of these very strong views out and you lay out some of these facts, usually the pushback has a vested financial interest in pushing back. And I think that's the part that people miss, is that when you put these great newsletters out and you put all these insights out and you tie together in a great story that's easy for people to follow, that pushback has got an interest in hitting you hard, and it's a financial interest.
There's a quote, I think it's from Lord Overston, which is, no force on earth can stop a people who are determined to grow suddenly rich. You know, the people have very short memories. Now, again, the kind of route we're pursuing, it isn't a route that necessarily anyone would necessarily wish to follow. Our clients are already, for better or for worse, reasonably affluent, if not outright wealthy. So our objective for those clients is not to double their money. It is, repeat, not to double their money. It is to try and protect it in real terms and help it grow, but help it grow in a way that it doesn't jeopardize the value of the pot. Not every investor has the same objective. Particularly people who are younger and who are closer towards the start of their savings or investment cycle, they're much more concerned about making effectively aggressive gains because they haven't got much money to begin with.
Yeah.
And the revelation for me came back in around 98 or 99 when I read a book called Against the Gods by Peter L. Bernstein.
Great book.
I'd recommend it to anybody, even people who have no interest in finance or investment, because it's a fantastic history of risk. Fantastic history of risk. It's almost a biography of a character called Risk through the ages. And one thing leapt out at me when I read that book for the first time, and it was a quote from a chap called Daniel Bernoulli. Now, Bernoulli will be known probably to anyone that's studied science to any specific, degree. He was a Renaissance man by all accounts, lived several hundred years ago, and was probably a bit of a genius. And there's a principle of fluid dynamics known as the Bernoulli principle. But the thing that I was most interested in was a quotation attributed to him where he said the following thing. He said, "If you're managing money for wealthy people, quote, the practical utility of any gain in portfolio value inversely relates to the size of the portfolio," unquote. Or to express that in plainer English, if you're managing money for wealthy people, just don't lose it. They've already got the money. They've already got the capital. They're not this is a broad brush statement.
Your utility changes. Your utility changes.
Exactly. And the point is, and what is absolutely clear, and it backs up Bernoulli's point, is, and as people have won the Nobel Prize for this, people are hardwired to be loss averse. So in other words, if I said to you, Mike, let's toss a coin. Heads you win $500. Tails you lose. You have to give me $500. It's an open question as to whether you take the bet. But if you took the bet and lost it, it's a racing certainty that feeling of loss will be felt by you between 2 and 3 times as intensely as the gain would generate a feeling of pleasure. In other words, it's not symmetrical. The human mind approaches and reacts to profits and losses in different ways and with different intensities. So to go back to first principles, if you've got let's call it a significant part of capital, of wealth, the chances are you want to keep it. For sure, you'd like it to grow. That's human nature too. But you probably do not want it to grow within such an uncontrolled way that you run the risk of losing a significant part of it. And that's the route we're trying to follow with clients. So, it is difficult when you're trying to manage money on what we would describe as a broadly conservative and certainly very well diversified basis. The worst of all worlds for us is to be sheltering in things like, gold bullion and trend following funds and very defensive stocks and objectively high quality bonds and the portfolio just sort of puttering along. And that's or obviously in the case of gold, the gold price has sort of been quite aggressively slammed over the last 18 months. that is the worst of all possible worlds for us if that's happening at exactly the same time the stock market's going through the roof. Because then there's the risk that a client will say, well, thanks very much, but I think I'm going to join the crowd making double-digit returns every year in the stock market. Thank you very much. But go back to your earlier point, there is a risk of a crash there. We've had two already in the last 13 years. Maybe we're not too far away from prospectively another one.
I want to lead, you've mentioned risk, you mentioned crash, and I want to ask you a final question here before I let you run. You give a great story in one of your newsletters, and I think this is very tangible where people can understand. And you talk about the U.S. Forest Service and their idea of preserving forests and how they went about that in the 1960s and 1970s. And obviously the unintended consequences that happened by trying to preserve forest and not let small fires start. And I'll let you take it from there. Let you explain the story.
Yeah, I think Nassim Taleb is written about the same phenomenon, and it's like you say, unforeseen consequences, and it's the problems that arise when you take a very aggressive, very sort of pro-cyclical, sort of defensive response to things happening. So at the first hint of a fire, you douse it quickly, and so the integrity of the forest is apparently kept. But all that's realistically happening is you're building up an ever greater amount of sort of dry tinder, such that when you get that final conflagration, the whole forest goes. Yeah. And I think that's a very, in the context of a sort of a dynamic, complex system, brackets the stock market, question mark, brackets, then the analogy, I think, or the metaphor very much holds. So I think we can roll back the clock and we can say, there were multiple times over the last 20, 30 years when the Federal Reserve, for example, intervened to avoid the apparent forest fire. So 1998, it was bailing out, or rather orchestrating a rescue for long-term capital management. In the early 2000s, it was slashing interest rates in the aftermath of the dot-com bust. But each time, the problem was deferred. But in the interim, as that problem was deferred, what effectively happened was it just ensured that the next time you had a systemic problem, it would be bigger than the one you thought you'd already solved. So interest rates, I'm a particular follower of I think, of what I understand sort of the Austrian business cycle, and that argument strongly suggests that, if you're looking for for proximate causes of the boom and bust cycle, look no further than the central bank, look no further than the Fed. Which entity was it that drove interest rates down to rock bottom levels that then caused a surge of interest in property? When that surge of interest in property then turned into a bust, it's not too difficult to see who the culprit is here.
Wash, rinse, repeat.
Indeed. So at the end of the day, all we're trying to do, and it sounds like a very modest objective in terms of the capital preservation in real terms, but precisely because of central bank activity, money printing, QE, apparently now seemingly to infinity, and this ongoing distortion of prices throughout the capital markets infrastructure, it makes what I would call sensible, classic value investing almost unimaginably difficult. So then the question is, what do we do? Happily for us, we think we have a solution of sorts in that, and it's effectively, it's a very humble response, which is, well, we don't actually know what the future is going to be like. We can worry about a variety of different scenarios, and we therefore invest on the basis that some of those scenarios may come to pass. But we've got no crystal ball because nobody has.
Yeah. Tim, I hope we can continue to have these conversations. I really enjoy your perspective, and where for the audience, and I will give the link also in my writings, but where for the audience, if they want to go to follow your weekly newsletter, where can they go? Where's the best place online?
Yeah, the best place, I put the archive up on the blog. It's thepriceofeverything.typepad.com.
Okay. Well, listen, I appreciate it. I love the perspective. And, for those people out there that want to sit back and say, oh, Mike, Tim, you guys are just dooming and glooming, you're missing out on this. Or look, I think we're all adults. We can all sit back and say there's trading and there's making money on one side. But, on the other side, there are policy questions. There are morals and ethics about how society and government is being run. And I don't think there's anything wrong with making comments about that and trying to figure out, as you said, from a detective perspective, what's going on. I think that's completely normal. So I appreciate it.
It's been a real pleasure. Thanks, Mike.
Take care. I really enjoyed that conversation with Tim. I hope to have him on regularly. Some great insights. Now, however, let me jump into this Bitcoin introduction that I caught from a TED speech. I think this is a really nice intro. And I'm not posting the full thing here in the podcast. You can go watch the full thing on YouTube. But this is a nice intro.
So if I was to ask you what the connection was between a bottle of Tide detergent and sweat was, you probably think that's the easiest question that you're going to be asked in Edinburgh all week. But if I was to say that they're both examples of alternative or new forms of currency in a hyper-connected, data-driven global economy, you probably think I was a little bit bonkers. But trust me, I work in advertising. And I am going to tell you the answer, but obviously after this short break. So a more kind of challenging question is one that I was asked actually by one of our writers a couple of weeks ago, and I didn't know the answer. What's the world's best performing currency? It's actually Bitcoin. Now, for those of you who may not be familiar, Bitcoin is a cryptocurrency, a virtual currency, synthetic currency. It was founded in 2008 by this anonymous programmer using the pseudonym Satoshi Nakamoto. No one knows who or what he is. He's almost like the Banksy of the internet. And I'm probably not going to do it proper service here, but my interpretation of how it works is that Bitcoins are released through this process of mining. So there's a network of computers, a challenge to solve a very complex mathematical problem, and the person that manages to solve it first gets the Bitcoins. So the Bitcoins are released, they're put into a public ledger called the blockchain, and then they float, so they become a currency. And completely decentralized, that's the sort of scary thing about this, which is why it's so popular. So it's not run by the authorities or the states, it's actually managed by the network. And the reason that it's proved very successful is it's private, it's anonymous, it's fast, and it's cheap. And you do get to the point where there's some wild fluctuations with Bitcoin. So in one level, it went from something like $13 to 266, literally in the space of 4 months, then crashed and lost half of its value in 6 hours. And it's currently around that kind of $110 mark in value. But what it does show is that it's sort of gaining ground, it's gaining respectability. You get services like Reddit and WordPress are actually accepting Bitcoin as a payment currency now. And that's sort of showing you that people are actually placing trust in technology, and it sort of started to trump and disrupt and interrogate traditional institutions and how we think about currencies and money. And that's not surprising if you think about the basket case that is the EU. I think there was a Gallup survey out recently that said something like, in America, trust in banks is at an all-time low. It's something like 21%.
As I said in the intro, there is nothing wrong with having a trading strategy that's completely trend following. But that doesn't mean you can't analyze the ethics and morals of society. I want liberty. Liberty in its purest sense. Let me behave and let me operate as long as I don't hurt other people. That's freedom. I know people love to debate, especially in America, the right and the left, Democrat versus Republican. Look, it's all the same. These elections don't really do anything. We all know it deep down. Now, if you allow yourself on election night to get all excited, your guy might win, the other guy's going to lose, and that allows you to sit back and some kind of bizarro satisfaction that the world or your life or whatever is going to get better. That's nuts, man. That's just nuts. Wake up. Democrats and Republicans in America are about state power. The state having the power to exert whatever they want to exert on you. That's the name of the game. I don't want to be on those teams. Look, I've had plenty of guests to my podcast that my friends, many people my friends, and they might have differing views on this subject. That's fine. I don't have a hatred for them. I just think, based on everything that I've seen in my life in America right now, Democrats and Republicans are the same, except Democrats openly admit we want more state power, and Republican politicians pretend they're against state power, pretend they're for less government, but the reality, they behave the same way. So their words don't match their actions. At least the Democrats' words and actions match. But that's a small quibble, for the reality is they're the same. And you know what? Who cares ultimately? I mean, seriously, go on an adventure. Start life. Let go of all this stuff. It's not going to change. It's only going to get worse. More and more people addicted to the dole, more and more people lost, the sheeple looking for the nipple to the matrix with no idea what to do. Okay, there's the negative part. How exciting if you're not one of those people. It's like walking through a zombie movie where everybody's a zombie and you're not. You can say, well, this sucks. They're all zombies. Or you could say, they're all zombies. They're not competitors. I mean, they're lost. They're not competitors. Look, I've taken very fondly to saying this in the last few months on my podcast. I've said it in speeches. In the great Stoic tradition, you are going to die. And if you're going to die, and you know it, and we all know it, live big. Live big. Isn't that a hell of a lot better than sitting around and having debates about left and right politics and whether your guy is going to give you a goodie versus another guy and all that other kind of BS? Man, that stuff sucks. I'd rather go see some site that you've never seen, meet new people, talk about building a business, the entrepreneurial passion, the spirit. Yeah. I'm talking about this stuff right now because frankly, it is part of my business. Part of my business is to break these issues down and to educate and give people a perspective. But you know what? When I turn the recorder off, hell, I don't think about this stuff. I'd rather watch a rerun of Kenny Powers or watch some crazy thing on the Discovery Channel or Animal Planet. And that's even if I turn the TV on. Frankly, I'd rather just be exploring. Exploring for me is the name of the game. The world's a big place, and it gets a lot bigger when you let go of all the distractions, all the nonsense. Have your plan. Stick to your plan. Your life plan, your trading plan. Let all the other crap just dissipate. Stop paying attention to the nonsense. Okay, that's my Patton-esque speech for the night. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.